I'm Trevor Phillips. This is Common Ground, where each week we look for agreement on a hot-button issue dividing the nation. Tonight, and with some flash photography,
parts of our mini-budget went further and faster than markets were expecting. So the way we are delivering our mission right now has to change.
Growth requires confidence and stability, and the United Kingdom will always pay its way.
We need to do more quickly to give certainty to the markets about our fiscal plans. Markets are asking serious questions about our commitment to sound public finances.
It was both frank and bold, and it appears, in the very short term at least, to have steadied the markets.
There will be great relief across the House that the markets have responded positively to my right honourable friend's statement.
Economic policy is being made with primarily the markets in mind.
Today has been an extremely difficult and turbulent day. Massive speculative flows have continued to disrupt the functioning of the exchange rate mechanism.
Not since 1992 and Black Wednesday, when the UK was thrown out of the ERM, have we had a moment quite like that.
We need to act now to reassure the markets of our fiscal discipline.
always in power but never in office. The markets, it seems, are calling the tune and our elected leaders are being compelled to dance in time. COVID and war have driven countries all over the world to spend money they haven't got. The markets have filled the gaps. Some argue 'twas ever thus. Governments have to come to terms with those who risk lending them cash. Foreign governments and speculators, yes, but also their own citizens who put their money into bonds and pensions. They decide where to put their own savings, and it's only fair that the greater the risk, the greater the reward. But others believe that democracies dice with the devil if they rely too heavily on borrowed money, and that politicians can end up paying over the odds, and worse, surrendering too much power to unelected and unaccountable financial institutions. Our choice tonight: accept the markets as a fact of life, even if they limit what democracies can do, or call a halt and pay the price in cuts and austerity. In the next 30 minutes, we go in search of common ground. With me tonight, the author and journalist Owen Jones, the financial analyst Louise Cooper, who is senior lecturer in finance at Kingston University Business School, and Sir John Gieve, the former deputy governor of the Bank of England. Let's start by making sure that we're all talking about the same thing. Now, I haven't worked in financial markets, nor has Owen, so let me start with you, John and Louise. Who or what are the people or institutions that matter when we're talking about stability of the markets? Louise?
There are lots and lots of different financial markets. There's credit default swaps, there's options markets, there's all sorts of financial markets. The three we really want to focus on is currency markets. Particularly if the pound goes down, the big problem for us is we import inflation. Inflation tomorrow expected to be 10%, bit problematic. Next market is the stock market. The UK stock market's been pretty poor for a very long time. That makes our companies cheap to buy from overseas investors, and it means if they want to raise new money, if companies want to raise new money, it's difficult for them to do it. But the third and most important market, I would say, at the moment, is the government borrowing markets, what we call gilts. And when a country has £2.4 trillion of debt, which is what we have, those borrowing costs can become highly problematic exceedingly quickly. So there are loads of financial markets, and they pop up every now and again with their consciousness as to what's happening. But the key one right now, in a world of increasing interest rates, is government borrowing markets globally, but our one is called gilts.
John, do you agree with that, that actually those are the key ones, and the one we need to keep our eye on most are the bond markets, the lending to government, when people talk about 10-year and 30-year yields, that one?
Yes, those two, and I'd put those ahead of the stock market, which goes up and down and isn't quite so critical to maintaining stability. As to who they are, There are some spectacular figures, individuals who appear on the front pages and do actually move quite large sums of money, but most of the players are in institutions. They're salary people sitting in banks of desks with the job of buying and selling currency, buying and selling bonds, trying to make a little bit better deals than the guy in the desk next door or down the street.
But these are meant to be sort of really boring outfits, aren't they? I mean, pensions...
They're supposed to be.
Absolutely,
this is meant to be the most boring kind of place to put your money because nobody takes any risks, nobody ever gets turned over or anything like that. What the heck happened?
Well, two things happened. Firstly, they've become less boring right with the way across the world. As inflation has gone up, and particularly in the West, we've seen interest rates starting to climb and an intention to send them higher in the United States. This is a big, big change. After 10 years, when interest rates were around zero, it now looks as though they're going to move up to 4 or 5% worldwide. So that has been disruptive. Huge changes are happening because of that. And then there was the UK problem, which was that we announced, or seemed to announce, that we weren't, our government wasn't much concerned about boring old stuff, about balancing the books. That was just Treasury orthodoxy. They were going to do something more radical, and then they followed that up with one side of a budget, the giveaways, without really making any attempt at all to explain how they were going to pay for it.
Oh, and do you recognise this picture? And is it your view that actually this was a sort of tactical, political mistake, or is there a systemic rottenness here?
Well, of course, systemic. I mean, one economist put it to me quite well that you should regard the markets like a dangerous guard dog. That you should, you should be very gentle. Don't make any sudden movements. Keep eye contact. No sudden surprises. And I think if you look at what the government did, they sacked the relevant civil servant.
Tom Scholar, the Perm Secretary.
Absolutely.
The Treasury.
They didn't go through the Office for Budget Responsibility. They didn't provide, you know, in a sense, what markets want is predictability. They want to know what's going to happen in the medium and long term. They don't want any sudden surprises. Now, you know, we can argue that this was an assault on democracy by the markets, but of course, the problem with that is this wasn't put actually in a democratic arena. It wasn't put to the British people in a general election. It actually wasn't even put to Conservative Party members. So it was a complete surprise thrown at the markets with a promise that there would be forecasts several months after the proposals had been implemented. But what I just think is interesting, because you mentioned the issue, of course, of debt. If you compare where we were when COVID happened, where we had obviously a vast sum of debt, far more than we did in 2010, for example, when Austerity was launched by David Cameron and George Osborne. But of course, you didn't have a sudden financial or economic or market reaction to the vast sums of money that was thrown, quite rightly, at keeping the economy running during COVID, because you obviously had a very different context where you didn't have inflation that's sweeping across the Western world, and then the expectation of interest rate rises, which is what obviously was already the context which this government you know, threw this bombshell into the market.
So what we're missing here is an explanation of what quantitative easing is, because we're talking about the bond market, the gilt market, and the power it has. And there's a fantastic quote, actually, from a political advisor of Clinton, who said, when I died, I wanted to be reincarnated as the president, the Pope, or a big baseball hitter. Mm-hmm. And he said, actually, what I've now learnt, because Clinton had his problems with the markets, what I've now learnt is I want to be reincarnated as the bond market, because then I can intimidate everybody. So it is true that the government borrowing markets have huge power, because if they look at governments and think they're being fiscally irresponsible with taxation and spending, they will say, we're going to charge you more money, we're going to charge you a higher interest rate. But what is really interesting about this debate is that because of quantitative easing, bond markets have not had that power for 15 years. They have not. In fact, the most powerful player in the bond markets has been, sorry, Sir John, to do this to you, has been the central banks, also not elected. OK? So the most powerful player has been the central banks. They have controlled the world for 15 years. But that is now ending because in a world of higher inflation, in a world of interest rates going up, quantitative easing is being reversed. And it is that has really changed the dynamic. Because up to now, governments could spend. Does not matter, because your central bank would buy up all your debt. That's what QE is. And it's that is now coming to an end. And it is that is really changing the dynamic.
Not that we're pointing the finger here or anything.
I'm not, no, I'm just sort of pointing out it is central banks who've had the power.
But former Deputy Governor of the Bank of England, is it your fault?
No, of course, that's completely true. I mean, what's happened is after years of having the monetary policy accelerator pressed to the floor, zero interest rates, buying all the gilts, quantitative easing, but inflation very well behaved, we've finally seen inflation rise, and much faster than central banks had allowed for, and they've reversed engines. So that's what's happening worldwide. I think in the British case, when we increased borrowing after the financial crisis and when we increased borrowing in COVID, we did it alongside everyone else. Everyone was doing it. It was a common international problem. And in a sense, we didn't stand out from the crowd. I think what we did in September was to really draw everyone's attention to us. This was presented as a radical change of policy that we were doing and no one else was doing. And that, I think, is a very dangerous thing to do when you have to borrow in international markets.
Just, Louise, before I come to Owen, I know you follow the international markets a lot. Are we unique in the situation that we're in?
I would say we're the canary in the mine. I would say we're the first one to be taken down. The first one, we're the bond vigilantes, as we call them, like the people that lend us money, that enable us to spend beyond what we tax, as all governments love to do, because we all want more spending, but nobody wants to pay for it, right? That's what governments do. And we are the first to be attacked. But I'm telling you, Italy, massive debt, massive government debt in Italy, new political party, highly problematic.
We're roughly parity with GDP at the moment. Well, actually,
no, we're bigger.
Debt below GDP.
No, we're way below. Italy is highly problematic.
Italy is above its GDP, isn't it?
Yeah, so Italy, debt to GDP is about 145%.
Yeah.
The UK is about 90%.
Yeah.
So Italy is the problem debt child of Europe. So I think we were the first, because as John explained, the mini-maxi budget, but I do not think we will be the last. Every government will be grappling with building up massive amounts of debt over the last 15 years, and now suddenly your central bank ain't buying it, so you have to convince somebody else to fund your excesses. And that's what's proving the problem. Because up to now, European Central Bank will buy it, Bank of England would buy it, Bank of Japan would buy it, Federal Reserve will buy it, everybody will buy it up. But now, that's not happening.
I just thought it was interesting going back to the financial crisis, because, of course, this is all being used now to essentially say, well, look, this is a vindication of the austerity policy pursued by George Osborne and David Cameron's government. I mean, we've got, the programme's called Common Ground. I do have common ground, it turns out, with Liz Truss and Kwesi Kwarteng, whose rhetoric very clear.
Well, just stop there and... Owen Jones, common ground with literally.
Yeah, comrades. Comrades.
Because
huge common ground. No, because what they accepted was austerity had failed. I mean, they made. She was talking about decades of stagnant economic growth, and actually, from the 80s onwards, we've had much lower average economic growth than for the rest of the post-war period. But she was essentially doing a critique of austerity, and she committed to not returning to those policies. But if you go back to what happened after the financial crash, what was so tragic about the argument then that the bond markets would discipline a government which didn't do austerity? But of course, borrowing costs were very low at that period. I mean, the tragedy is that we could have borrowed to invest, and we didn't in that period. And the argument was, if you didn't, then the credit agencies would strip Britain of its credit rating, and therefore government borrowing would surge. Well, that happened in 2013 anyway. During austerity, our AAA rating was taken away. Did government borrowing costs go up? No, they did not. There wasn't a revolt of the bond market. So I just think it's really important that we don't end up in a... because I know this is what's being used at the moment, to justify the policy of austerity, which took place after 2010, on the grounds that this would have happened if George Osborne hadn't done that, because it wouldn't have happened.
I want to come back to that point in a moment, but let's go to the sort of the central question, really, which is the relative power of the markets, and we don't need to think about it as a conspiracy. This is, as we've heard, it's all our savings. We expect our pension funds to get the best out for us. But have we unwittingly walked into a situation where, in a sense, these markets have power over democracies, our democracy particularly, by limiting the options that governments have? Well,
yeah, in the last 2 generations, elected governments have abdicated their responsibilities to the market. That's what the policies of deregulation and privatisation have actively sought to do, where governments, as a consequence, basically, as a matter of virtue, praise the idea that they are no longer responsible for large sections of the economy and society, and that the market instead will provide all. That's why we privatise basic utilities, on the basis that energy would be best provided, for example, by the private sector. Didn't turn out that way. Or water, that you would get suddenly water companies able to get all the access to private capital. Never happened. That they would better invest in their services. Didn't happen. But governments could wash their hands of these things and say, not our problem, Gov, nothing to do with us. The market now is in charge of providing these functions. I would argue that obviously has been a disaster. I mean, other arguments you could say is, you know, capital controls, I suppose. I mean...
OK, let me just ask, John, whether you recognise that picture of the relationship between the market and our governments in the, well, let's say, since 2010.
I recognise the attack. I don't buy it. I mean, I think governments are held responsible, actually, for the prosperity of the people and the success of the economy. And when, so if you like, the move to regulated markets rather than public utilities was taken on the basis that would improve our economic performance, which it did relatively for up until the financial crisis. We've absolutely had a bad 10 years. But we've had a really bad 10 years in terms of productivity and growth. That's absolutely true. Partly that would have been to do with the austerity policies, but also I think there have been other more profound reasons for it. We haven't had good training policies and education policies.
Research and development.
Planning. We appear to have done a bit better on R&D than we thought, but yes, absolutely. Private sector investment and public sector investment have been very low. And so I think when you're dealing with productivity and growth, you've got to look at it almost a decade at a time. That was one of the difficulties about the mini-budget, was saying this is all about growth. But, you know, growth in 5 years' time, I mean, what they were promising us was cash tomorrow for growth in 5 years' time. And that didn't quite add up.
I don't want to take us too far onto what people these days call the supply side questions, because that's, in a way, slightly different. I just want to stick, for the moment, with the extent to which we're in a different situation than we have been in the past, where the consideration of stability of the markets has been a factor for governments, compared to what appears to have been the situation in the last 10 days or so, where it has become the objective of policy for governments. Louise?
I mean, to a certain extent, if you don't build up the debt, you're not, you're not, at the exposure. I mean, that's the brutal reality. If you don't have huge amounts of debt, then it doesn't matter. But if you have built up enormous quantities of debt, which is what we have done since the global financial crisis, I keep saying 500 billion of national debt pre the global financial crisis, 2.4 trillion now. So if we didn't have 2.4 trillion of debt, we would be less exposed to the financial markets. But the key thing, the key thing, is that quantitative easing has changed it. Now, I know a lot of people don't understand QE, but essentially the government's issue debt, gilts in the UK, or loads of other words, or treasury bonds in America, or bunds in Germany, or whatever you want to call them, oats in, and they issue debt. And normally, if you tax less than you spend, somebody has to fund it. In the last 15 years, one part of government has issued the debt, the other part separate. Your central bank has bought it all up. You have not needed to persuade anybody, right? The central bank is the power in the room. Nobody in the markets ever takes the opposing view to the central bank, because the central bank is the most powerful player. Now, that central bank is not there anymore. And suddenly you've got to convince somebody, will you fund us?
Well, Andrew
that's the problem.
As Andrew Bailey said last week to everybody, we're going to buy some of this debt, but actually on Friday it all stops. I think that called a halt. Owen, in a way, isn't this a sort of natural outcome of very exceptional circumstances? COVID, huge amounts of public spending, and the war in Ukraine, and that actually, at some point, as it were, normal service will be resumed, and the relationship between the politicians and the money men will be under control from the point of view of the democracy?
Well, I mean, all Western European nations have had to deal with those exact same problems. It's us who uniquely suffered the crisis that we had. I know you said with the canary in the mine, but, I mean, look, we are clearly the outlier as things stand in terms of what's just happened. I mean, there was look, you know, from a leftist perspective, you could almost, you know, you'd think somebody like myself would say, well, sod the markets, you know, you should just do exactly what you want to do. In my case, it would obviously have not been huge tax cuts for rich people. It would have been investment in public services. It would have been public ownership, things like that. But you know what? You know, a clever left-wing argument would be to accept, well, actually, we shouldn't have the world in which we live in which markets have been handed far too much control. We should have done what Norway did when they had North Sea oil. They built up a sovereign wealth fund, for example. Singapore's often looked at by libertarian economic supporters, but they have huge state intervention in the economy, state-owned enterprises which actually intervene to invest in things. We haven't done that. So what, you know, John McDonnell, for example, the Shadow Chancellor, you know... Former Shadow Chancellor of Labour, definitely not the Shadow Chancellor anymore. You know, a lot of what he did was completely drowned out in the noise in terms of that whole Corbyn period. Because his view was, if you want to do radical things, you can't surprise the markets. So that's why they tried to set out in great detail what they would do. They went on a prawn cocktail offensive in the city. They tried to talk to financiers on a daily basis. And they came up with a fiscal rule, for example, which was you would only borrow to invest. You wouldn't borrow for anything else. So actually what they were trying to do is say, well, look, this isn't the world we would have designed. The markets do have far much control, but that doesn't mean you can't have a radical transformative government that does things in the economy, which a lot of those investors won't like, but as long as they're offered reassurance, as long as they're offered long-term stability, then they won't take fright. This government didn't do that. This government just surprised them. It just went boo to a very angry dog, which then bit it.
Oh, and I hope you won't mind me saying this, but that sounds like a preposterously Blairite prospectus. And
well, I don't think Blair would start nationalising things and taxing the rich.
In the sense that we do have some common ground here, which is that actually there is a place for markets, but actually you have to get the relationship right. And I just want to spend our last few minutes talking about what is the right relationship here, John? I mean, let's assume that we're in for, as Louise is saying, quite a long period of inflation. We're not going to be able to run down this debt very easily, and therefore there's going to have to be a clear relationship between those we've borrowed from and the state. Now, how do you manage that relationship in a way that means that governments aren't constantly looking over their shoulders at, you know, traders in Hong Kong and what gives them the jitters and so on?
Well, I was in the Treasury for many, many years, and we never stopped worrying about what traders were going to do, because they could blow us out of the water, as they did in the ERM, as they did in the 70s, and as they've done again right now. You've got to see we have to live in the world as it exists. The markets are a constraint on what you can do, and the way, you know, which successive governments have dealt with that is to set out their version of John McDonnell, the medium-term plan, why actually we can afford this over a period of years, and that we're not going to bust the bank. And you know, you can imagine that if Rishi Sunak had won the leadership election, he wouldn't have had a statement in September. He would be sweating right now on what to say in his half-yearly budget in November, trying to make the numbers add up. But he would, as his predecessors had done, set it in a medium-term context in which he says, look, we are borrowing a hell of a lot for the energy price guarantee, for example, in the next 6 months, 18 months. But it's all right. Look, I can show you that this is affordable in the medium term. So that's the point of these fiscal rules, medium-term plans, and so on. And you've got to have them because markets are a fact of life.
Chancellor Louise, what would you be doing this week?
I'd probably fire my Prime Minister. Can you do that?
Do we have a Prime Minister?
So
you'd fire Jeremy Hunt, why would you fire him?
So this is the problem, right? So the grown-up appeared, he calmed everything down, right? But from a financial market perspective, that's been great. But it hasn't really gone very far in terms of the risk premium for UK assets. The extra additional interest rate the government has to pay because of our perceived uncertainty, risk, who the hell knows what's going on in UK politics. And
what somebody unkindly has called the moron premium risk.
The moron premium risk. And I'm afraid that's still there. That's still there in all sterling assets. And the most important one it's there for is in our borrowing costs, OK? And the fact that it's in our borrowing costs, there was a Bloomberg economics analysis suggesting it's going to cost us £10 billion a year for every year that we have that premium because of what's happened in the last 3 to 4 weeks. Now, £10 billion buys you a lot.
What Hunt was trying to do and why he had this sort of mini foretaste was actually to try and reduce the rate of interest he had to assume in his forward projections and narrow that to 10 from 20, you know, which he's done.
But it's not gone. But it's not gone.
Owen, you're a special advisor.
I'm special. Yeah, blimey. I think make me supreme dictator. See how the markets respond to that. No, I think what's been missing in this actually is quite an interesting detail because the tragedy is now that borrowing costs are higher, and I think that makes the argument ever stronger for taxing those who have wealth and to increase income tax and to increase corporation tax. And what's interesting about what's just happened is a stereotypical argument against left-wing ideas or economic ideas would be that if you seek to increase taxes on those who have businesses or those with wealth, you'll scare the markets. But what scared the markets this time wasn't the idea of increasing taxes on big business. It was actually the idea of not increasing taxes on big business. So the argument there is made very, very clearly for an increase in taxes on those who actually have a huge amount of money. We created record numbers of billionaires, for example, during the COVID pandemic. Given corporation, if they hadn't have increased corporation tax or they hadn't reversed their decision not to increase corporation tax, then the markets clearly were going to strangle the British economy. So obviously the case now, given borrowing costs have gone up, is they've got to apply that principle more broadly. OK.
Well, we have a remarkable level of agreement here. There's a place for the market. There is a relationship.
I don't want it. Stop with it.
There is in the real world, there's a place for market. That there is a relationship between governments and markets which can be successful. And actually, it's not too difficult to see exactly what that is. At the heart of it is certainty, even if you don't necessarily agree. And I think one of the things that hasn't been specifically said, but I take from this discussion, is that we should think of markets not as moral actors, but as driven by particular imperatives. And they don't have the markets don't have opinions about what should happen, but you need to anticipate what they might or might not do in a smart way. More to talk about. I'm sure we're going to be returning to this. Thank you, all three of you, very much. Thank you for watching. Stay with us. We'll have all of today's news coming up after the break.